Turkey's consumer inflation climbed near the highest level since President Erdogan came to power 15 years ago, spurring calls for higher interest rates to rein in prices. We're back with Talib Sheikh of Jupiter Asset Management and Jeremy Stretch of CIBC. Jeremy, this goes back to what we saw in lira over the last couple of months, and actually the fact that President Erdogan does not want higher rates. How much of this is it a Fed story and a dollar funding story, and how much of it is it purely politics in the country?
Well, I think it's an element of both, but I think there's certainly a very sizable element in terms of the domestic considerations as regards Turkey. So clearly markets were very frustrated when the central bank didn't hike rates as expected back in July. They obviously were much more aggressive in the last meeting, but in the light of this significant uptick in inflation, certainly well above that expected by the market, and seeing real rates moving back towards very sort of negligible levels, then there is going to be more pressure on the central bank to act. And of course that puts the central bank in a rather invidious position in view of the continued strident criticism of higher rates from the president. Invidious
is a very good word. When you look at Talib, at how the Fed is thinking, does the Fed look at Turkey? Do they look at Argentina and try to mitigate risks?
I don't think so. You haven't really seen them blink at all. I guess they would view these as relatively idiosyncratic events, clearly, as we just touched on in Turkey. I do think the politics around that is much more difficult. Contrast that with what's going on in Argentina, where they really have engaged with the IMF to a great degree. They've taken the medicine. And I thought it was interesting, other than the wobble that we've seen on Turkey this morning, that these two countries, which were the first emerging market countries to have a severe wobble, had to some degree stabilised over the last couple of weeks and start to lure people back into attracted by that carry. Certainly for our portfolios, we think it's probably a bit early to be getting aggressive, particularly across the sovereign space. But what we have been doing is been looking at emerging market corporates, where we do think that there's some really great companies which have been damaged, really, as we've seen that wave of liquidity coming out of those markets. So, relatively non-consensus, we've been dipping our toe back in there. We do think that's pretty attractive, but it's rather like a discussion around Italy. It's very difficult to trade that headline sovereign risk, and for the moment we sit on the sidelines on that.
Jeremy, very quickly here, I want to show a chart which I think graphically describes, folks, what we're seeing in so many EM. This is Turkish inflation. And all you got to know, Jeremy Stretch, is we're out 6 standard deviations. I'm sorry, Jeremy, it's a medical chart. What does it signal when we see a 6 deviation off trend move in inflation? I'm sorry, it's got ramifications, doesn't it?
Well, indeed it does, and clearly it's a legacy function of the collapse in the currency, the collapse in confidence in the currency. When you overlay that with, of course, the rise in the oil price, which of course is impacting other emerging market nations who are significant oil importers as well, then it does underline the fact that the central bank do need to act, and it's going to imply much slower growth. And of course that's a problem politically for the president.